Dengan pengumuman ini, maka pengurus bank diminta agar tidak meninggalkan Indonesia guna penyelesaian likuidasi.
Pada tahun 1998, badai krisis moneter dan perbankan menghantam Indonesia. Masyarakat berbondong-bondong antri di bank dan ATM untuk menarik dana mereka. Kekacauan terjadi di mana-mana. Situasi chaos ini disebabkan hilangnya kepercayaan dari masyarakat terhadap perbankan. 16 bank saat itu kolaps.
Wah, ini bagaimana? Uang saya hilang. Bayangkan kalau orang waktu itu uangnya ratusan juta aja udah besar sekali. Sehingga bulan Desember itu ada surat dari Mensesnek ya, kepada BI dan Menteri Keuangan untuk membantu, eksplisit disebutkan, keluarkan BLBI, bantuan likuiditas Bank Indonesia. Itu Desember itu.
Berdasarkan undang-undang ini, LPS merupakan lembaga independen yang berfungsi menjamin simpanan nasabah penyimpanan. Lembaga ini pun turut aktif dalam memelihara stabilitas sistem perbankan sesuai dengan kewenangannya. Setahun kemudian, tepatnya pada 22 September 2005, LPS resmi beroperasi.
Negara-negara lain juga masih mengalami krisis ya. Di Australia, perbankan juga, kemudian di Singapura, Malaysia, Hong Kong. Tapi terus terang, waktu kita mendirikan LPS, kita banyak mengadap model dari inilah, Kanada gitu ya. Karena memang itu model yang cukup bagus lah itu diambil gitu ya, mengenai lembaga penjamin simpanan ini.
Major financial institutions have teetered on the edge of collapse, and some have failed.
Krisis keuangan yang berawal di Amerika Serikat pada tahun 2007, dampaknya mulai dirasakan ke seluruh dunia, termasuk negara-negara berkembang pada tahun 2008. Di Indonesia, imbas krisis keuangan tersebut mulai terasa terutama menjelang akhir 2008. Dampak krisis keuangan global yang paling terasa adalah ketatnya likuiditas di pasar uang antar bank. Penurunan harga saham yang tajam, potensi meningkatnya kredit bermasalah, serta derasnya aliran modal keluar yang menekan nilai tukar rupiah. LPS pun memasuki babak baru dalam pelaksanaan fungsinya, yaitu untuk menyehatkan kembali PT Bank Senturi Tbk. Upaya yang ditempuh nyatanya berbuah manis. Bank Senturi keluar dari status dalam pengawasan khusus oleh Bank Indonesia pada 11 Agustus 2009. Kinerja keuangan PT Bank Senturi pun terus diperbaiki hingga memenuhi ketentuan tentang kesehatan bank. Pada akhirnya, sejak 3 Oktober 2009, Bank Senturi secara resmi berganti nama menjadi PT Bank Mutiara Tbk.
Pada tahun 2014, bulan November 20, kita lakukan RUPS LB, penjualan pengalihan saham dari LPS kepada pemenang, yaitu G-Trust dari Jepang. Ya. Perusahaan yang juga bergerak di bidang keuangan, yang mempunyai aktivitas investasi keuangan di luar Jepang, yang telah juga dinyatakan oleh OJK lulus dalam fit and proper test. Harga yang disepakati 4,4 triliun, ekuivalen dengan recovery rate 55%, ekuivalen dengan price to book ratio yang 3,2 kali. Ya. Jumlah ini 3,2 kali jauh di atas rata-rata price to book value dari jual beli perbankan di Indonesia yang 2 kali.
Dalam perjalanannya, DPR dan pemerintah mengesahkan Undang-Undang Pencegahan dan Penanganan Krisis Sistem Keuangan atau PPKSK. Undang-undang ini memberikan mandat baru bagi LPS, terutama dalam penanganan krisis keuangan. Sidang Paripurna Dewan Perwakilan Rakyat pun menyetujui pengesahan Undang-Undang PPKSK secara aklamasi pada 17 Maret 2016 dan diundangkan pada 15 April 2016. Undang-undang PPKSK juga memberikan kesempatan kepada LPS untuk masuk lebih awal ke dalam bank sistemik yang mengalami permasalahan solvabilitas. Langkah ini tentunya untuk menentukan resolusi penyihatan yang tepat.
Dengan sekarang disahkannya Undang-Undang PPKSK, peranan dan tantangan LPS menjadi semakin besar. Kalau pada saat yang lalu adalah betul-betul menjaga dan memberikan jaminan bagi simpanan masyarakat di perbankan, peranan LPS sekarang meningkat menjadi pelaksana program restrukturisasi perbankan.
LPS juga memperoleh metode baru dalam penanganan bank sistemik seperti halnya pengalihan sebagian atau seluruh aset dan kewajiban kepada bank lain atau disebut juga purchase and assumption. Kemudian, LPS dapat melakukan metode penggunaan bank perantara untuk menerima pengalihan sebagian atau seluruh aset dan kewajiban dari bank sistemik tersebut, serta penyertaan modal sementara yang telah diatur dalam Undang-Undang LPS. Undang-Undang PPKSK juga memberikan mandat kepada LPS untuk melaksanakan program restrukturisasi perbankan atau PRP dalam kondisi tertentu, seperti krisis sistem keuangan dan permasalahan sektor perbankan yang membahayakan perekonomian nasional.
Di dalam proses yang paling terakhir khususnya, itu perlu ada penguatan. Disinilah peran LPS, tugas dan wewenang LPS tidak lagi hanya sekedar menjamin simpanan masyarakat, tetapi juga memperkuat proses penanganan bank. Dan di dalam Undang-Undang PPKSK ini, tugas dan kewenangan LPS itu menjadi lebih luas. Dari sebelumnya hanya Paybox Plus menjadi juga sebagai otoritas di bidang resolusi bank.
Perkembangan sektor perbankan yang dinamis seiring dengan adanya kebutuhan internal membuat LPS melaksanakan program transformasi. Dengan latar belakang Undang-Undang PPKSK, program ini diawali dengan perubahan visi dan misi LPS. Visi LPS adalah menjadi lembaga yang terdepan, terpercaya, dan diakui di tingkat nasional dan internasional dalam menjamin simpanan nasabah dan melaksanakan resolusi bank untuk mendorong dan memelihara stabilitas sistem keuangan. Sedangkan misi LPS adalah berkomitmen untuk menyelenggarakan penjamin simpanan yang efektif dalam rangka melindungi nasabah, melaksanakan resolusi bank yang efektif dan efisien, melaksanakan penanganan krisis melalui restrukturisasi bank yang efektif dan efisien, dan berperan aktif dalam mendorong dan memelihara stabilitas sistem keuangan nasional. Berdasarkan data per Agustus 2021, jumlah rekening simpanan yang dijamin LPS telah mencapai di atas target, yaitu 99,92%. Atau lebih dari 360 juta rekening. Angka ini melebihi target yang ditetapkan Undang-Undang LPS sebesar 90%. LPS bersama anggota KSSK, yakni Kementerian Keuangan, Bank Indonesia, dan OJK, melakukan koordinasi dan komunikasi secara intensif demi terciptanya sinergi kebijakan untuk menjaga stabilitas keuangan dalam rangka mendorong pemulihan ekonomi nasional.
Di usia 16 tahun ini, LPS berkomitmen untuk terus berinovasi dan memperbaiki diri, karena kami sadar amanah yang diberikan dan tantangan yang kami hadapi semakin berat. Kami berkomitmen untuk menjaga kepercayaan nasabah perbankan melalui program penjaminan simpanan dan resolusi bank. Pada kesempatan ini, izinkan saya mengucapkan terima kasih kepada seluruh masyarakat Indonesia atas dukungannya kepada LPS.
Science without nobility is blind. The core of Universitas 11 Maret logo, which is a head-like shape with a flame in its center, is described as Wiku. The term Wiku is Old Javanese, borrowed from Pali, meaning an educated noble disciple. The flame, or Prabha, in the center of Wiku's head represents the brilliance, wisdom, and nobility of the human mind. The flame also symbolizes the light of knowledge that shines and makes a positive and eternal impact on the world and humanity. Universitas 11 Maret, established on March 11, 1976, is one of the leading universities in Indonesia. Its noble goal is to contribute to the development of the nation through education, research, and innovation that benefits society. Universitas 11 Maret has built its vision and strategic plan on becoming an internationally excellent center of development of science, technology, and arts based on the noble values of national culture, focusing on enhancing its specialized subject areas and on developing its capacity to meet world-class standards. Universitas 11 Maret has established 3 centers of excellence in science and technology. The 3 centers are Center of Excellence in Lithium-Ion Battery Technology, Center of Excellence in FinTech, Financial Technology, and Center of Excellence in Javanology that focuses on the study, development, and preservation of Javanese culture. Universitas 11 Maret is located in the city of Surakarta, also known as Solo. Solo is a very comfortable city to live in, where Javanese culture and modern life combine. The life in Solo, which upholds the value of harmony, has prepared Universitas 11 Maret graduates to be future leaders who are tough, creative, friendly, generous, calm, and adaptive. To achieve the vision of Indonesian higher education, freedom to learn, independent campus, Universitas 11 Maret offers a variety of courses on a wide range of subjects conducted by 11 faculties, a vocational school, and a graduate school. Various library services, such as thousands of print books and ebooks, access to various international journals, and academic librarian assistants are available to support the teaching and learning process and promote the academic achievement of all students, lecturers, and researchers. With a comfortable learning environment, a green campus, and supported by an integrated information system, Universitas 11 Maret has an academic culture that fosters a global perspective and is prepared for Education 4.0. Active and strong international partnerships and collaborations have become an integral part of the university. International partnerships provide opportunities for student and staff mobility, as well as collaborative research and community service projects. In addition to being a center of excellence, Universitas 11 Maret is home to students from all 34 provinces in Indonesia and 33 countries in the world. This creates a multicultural environment that promotes mutual understanding. Embracing diversity and respecting all cultures makes every student feel recognized and valued. The complexity of the modern world is continuously increasing. We live in an uncertain world where change is rapid and unpredictable. Universities have a pivotal role to play in preparing graduates for jobs that don't exist yet, for technologies that haven't been invented, and for problems that need innovative solutions.
Universitas 11 Maret has 3 main agendas toward a world-class university. Acceleration in various fields of development is needed by embracing the foundation of UNS, Benteng Pancasila. Therefore, 5 strategic policy pillars were decided.
It is important to understand that flexibility and adaptability are the keys to growth in the rapidly changing 21st century. This is what encouraged Universitas 11 Maret to shift its governance and management to an autonomous public university. With this change, Universitas 11 Maret will have the autonomy and independence to improve the quality of teaching, learning, and research in implementing the 5 development pillars of Universitas 11 Maret to accelerate its transformation process towards becoming a world-class university. Universitas 11 Maret.
Speakers and all participants, we want to inform you that International Webinar Financial Institution Economic Recovery Global Perspective is about to begin. And for the first agenda of today, I will humbly request all of you to open up your camera as we want to sing Indonesia National Anthem, Indonesia Raya. Thank you very much. And good morning, good afternoon, and good evening. Professor Sajidan, Vice Rector for Planning, Partnership, Business and Information, Universitas 11 Maret. Mr. Didik Madiono, Member of Board Commissioner Indonesia Deposit Insurer Corporation, LPS. Professor John Williams from Bangor University, UK. Professor John O.S. Wilson, University of St. Andrews, UK. Professor Ahmed Farouk Aisan from Hamad bin Khalifa University, Qatar. Dr. Ruth Tahning from Université de Limoges, France, Dr. Aldi Farih Asanta from Universitas 11 Maret, and all invited attendees and participants. Assalamualaikum warahmatullahi wabarakatuh, and welcome to the international webinar, International Financial Institution and Economic Recovery for Global Perspective, organized by Universitas 11 Maret and supported by Indonesia Deposit Insurer Corporation and UNS Fintech Center. I'm Dewanti Chainingsi, and it's such a pleasure for me to be part of this significant event. And I want to inform you that this event is the part of the Universitas 11 Maret anniversary agenda and also the side event of G20 Indonesia presidency. And to proceed to the first agenda of today, I would humbly invite the Professor Sajidan to deliver the opening remark for all of you. So, Professor Sajidan, very good afternoon, Prof.
Okay, thank you, Mbak Dewanti.
So, please, Professor, platform is yours.
Okay. Assalamualaikum warahmatullahi wabarakatuh. Good morning, good afternoon, and good evening. Mr. Didik Madiono, Board of Commissioner Member Indonesia Deposit Insurance Corporation, LPS. Professor John William, Banker University, UK. Thank you for your coming here. Professor John S. Wilson, University of St. Andrew, UK. Professor Ahmed Farouk Asyan from Hamad bin Khalifa University, Qatar. Thank you. And Dr. Ruth Stagner, University de Limoges, France. Thank you. And Dr. Aldi Paris Aksanta, Universitas 11 Maret, Indonesia, and all participants. First of all, I would like to welcome you to the international webinar, Financial Institution and Economic Recovery, Global Perspective. Speaker and participant, this international webinar is a series of agendas that we prepare to celebrate our 46th anniversary and a side event support to the G20 Indonesia Presidency 2022. Today's webinar has a topic focus in financial institution and economic recovery global perspective. As we have been witnessing the whole world hit by COVID-19 pandemic for almost 3 years, neither sector is immune from the COVID-19 pandemic nor the economic sector. The World Bank report that the global economy is poised to stage its most robust post-recession recovery in 80 years in 2021. However, the rebound is expected to be uneven across countries. Major economies look set to register strong growth even as many developing economies lag. And to comprehensively understand how the financial sector work to respond to the recent economic condition, this webinar bring up the regulator and respectable invited speaker to deeply discuss this issue. On this occasion, I would like to say thanks you for Indonesia Deposit Insurance Corporation, IDIC, LPS, to fully support this webinar, and also respectable invited speaker who willingly attend this event. I'm sure we will have a fruitful discussion as we have a list of notable invited speakers. I personally hope that the international webinar will help us build a comprehensive understanding of financial institution role in recovering the economy due to pandemics. Enjoy the discussion. Thank you very much for your attention. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh, and thank you very much, Professor Sajidan, for such a warm welcoming remarks and a strong point that hopefully by joining this webinar we can have a comprehensive understanding on about the financial institution and the recovery of the economy during the pandemic itself. And ladies and gentlemen, and all of distinguished speakers, proceeding to the next agenda, we will have the keynote speech that will addressing our theme today. And the keynote speech for today will be delivered by Mr. Didik Madiono. He is the Board Commissioner member of Indonesia Deposit Insurance Corporation, LPS, also Chief of the Risk Management Committee, Chief of Information Committee, and Chief of Sharia Committee. He got the Bachelor in Economics from the University of Gajah Mada and hold the Master Management from the Asian Institute of Management, Manila. And he has been working for the IDIC for almost more than 10 years. So without further ado, let me humbly invite Mr. Didik Madiono. So very good afternoon, Mr. Didik Madiono. Can you hear me?
Yes, I can hear you.
Perfect. So please,
Okay.
Mr. Didik, platform is yours.
Okay, thank you. Bismillahirrahmanirrahim. The Honorable Professor Sajidan, Vice Rector for Planning, Partnership, Business and Information, University of 11 Maret, Professor John Williams from Bangor University, United Kingdom, Professor John Wilson, University of St. Andrews, United Kingdom, Professor Ahmed Farouk Aisan from Hamad bin Khalifa University of Qatar, Dr. Ruth Takneng from University de Limoges, France, Dr. Aldi Faris Askanta from University of 11 Maret, and all distinguished participants and of this webinar. Assalamualaikum warahmatullahi wabarakatuh. Good morning for participants in UK and France, and good afternoon for participants from Qatar and Indonesia. First of all, I would like to praise the Almighty for His blessing so that we all may gather virtually in this delightful moment. I would also like to extend our sincere gratitude to 11 Maret University for inviting IDIC to share our thoughts and participate in this excellent webinar. Ladies and gentlemen, amid the ongoing vaccination in many countries, overall positive cases of COVID-19 globally have also been decreasing. However, we should be wary of new variants of COVID-19 virus. In some countries, particularly some of Indonesian main trade partners such as China, Thailand, Vietnam, and South Korea are still facing another COVID-19 wave. In Indonesia, both the number of daily cases and the number of daily deaths due to COVID-19 are on a decreasing trend, particularly since the rapid continuation of the mass vaccination program along with social distancing and health protocol measures implemented during the recent Omicron wave. These collaborative efforts have increased people's confidence in economic recovery. However, going forward, it is important to closely observe the impact of upcoming Eid holidays that is due to start early next month toward the number of cases. In line with the above, the Google Mobility Index that tracks the movement of people in certain areas also show promising recovery. This also supports the notion the economic activities are gradually returning to normal. Ladies and gentlemen, in 2021, Indonesia GDP has come back to grow positively, which is 3.69%, and it is projected to keep recovering well in 2022 and 2023. The latest data of several indicators for Indonesian business activities, consumption, investment, and net export have shown promising improvements. Both the demand and supply side indicators are showing signs of strong recovery. Ladies and gentlemen, in the meantime, the banking industry shows resilient performance. Credits have become back to grow positively, which is credit growth is 6.33% as of February 2022. While credit risk remains under control, that is, gross NPL stand at 3.08% as of February 2022. Meanwhile, the bank capital is well above the international standard and the liquidity is ample. As of February, capital adequacy ratio is 25.82%. Meanwhile, in the deposit spectrum, there is a consistent growth in demand deposit. As companies typically utilize demand deposit accounts to finance its day-to-day operation and their investment, the growth in demand deposit may indicate the increasing confidence in the corporate sector. Another way this may be interpreted is that the company are getting ready to spend and invest their money, which will contribute further to the economic recovery. Ladies and gentlemen, the law number 9 of 2016 regarding the prevention and resolution of financial system crisis, we call it PPKSK, mandated the formation of the Financial System Stability Committee, KSSK, consisting of Minister of Finance, the Governor of Bank Indonesia, the Chairperson of Financial Service Authority, and the Chairperson of Indonesian Deposit Insurance Corporation, or LPS. Synergizing together OJK, BI, LPS, and Minister of Finance protect the financial system stability in Indonesia and financial safety net. Ladies and gentlemen, in order to tackle the adverse impact of the pandemic and to support economic recovery, members of KSSK are constantly synergizing their policies. Several policies enacted by the Minister of Finance, BI, and OJK are shown in the slide. Meanwhile, the IDIC also enact a number of policies, including maintaining low deposit insurance rate in order to provide extra room for the banks in managing its cost of funds and to support banking intermediation. IDIC has cut its deposit insurance rate several times. Since 2020, IDIC has cut the deposit insurance rate as much as 250 basis points for deposit in rupiah and 150 basis points for deposit in foreign currency. At this moment, deposit insurance rate stand at 3.50% for rupiah deposit in commercial bank, 6% for rural banks or BPR, and 0.25% for foreign currency denominated deposits. These rates are in effect from January 2022 up to May 2022. IDIC also allow relaxation of penalties on deposit insurance premium payment, as well as the extension of the deadline for report submission by the banks. Going forward, IDIC plans to conduct trial for single customer view or SCV application, which will support IDIC's function as a resolution authority. Moreover, IDIC will also conduct socialization program for resolution plan to certain qualified banks. Ladies and gentlemen, as mandated by the law, IDIC is moving toward the role of risk minimizer in the financial system. According to Hasan et al. In 2017, the risk minimizer role of deposit insurance program was able to provide stabilization effect during the global financial crisis in 2008. Among other things, the risk minimizing deposit insurance program successfully hampered the decrease in deposit, while at the same time improved the supply of the credit. In the risk minimizer role, IDIC would not only serve as the pay box for the deposit insurance claim, but also are able to conduct early intervention in troubled banks. This role would also require tighter and more integrated coordination between members of KSSK in order to safeguard the financial system stability. Ladies and gentlemen, deposit up to Indonesian rupiah 2 billion are covered in deposit insurance program. IDIC Deposit Insurance Program cover deposit up to 2 billion ADR per account holder per bank. As of February 2022, IDIC covers as many as 99.93% of deposit account in the banking industry, or 447.05 million accounts. The current IDIC deposit insurance limit is comparable to 32.2 times national GDP per capita of 2021. This ratio is way above the average for the upper middle income countries, which is 6.3 times GDP per capita, and for lower middle income countries, which is 11.3 times GDP per capita. Ladies and gentlemen, the deposit insurance rate cuts has successfully decreased banks' cost of funds. This is indicated by the similar decreasing trend in interest rate for time deposit. Moreover, the decrease in the cost of funds eventually translates into the decrease in the interest rate of the credit. Even during the period in which the central bank rate remains unchanged, which is from February 2021 until now, the continuing decrease of deposit insurance rate still leads to decrease in interest rate in both deposit and credit. Ladies and gentlemen, the rise in geopolitical tension over Russia-Ukraine conflict causes global commodity prices to rise, especially energy, food, and metals. This contributes to rising global inflation. The conflict also causes volatility in financial market globally, which potentially hinder global economic recovery. Advanced countries are entering into monetary policy normalization period to tame inflation through quantitative easing, tapering, and rising central bank rate. Global supply chain constraints may still be looming for longer, especially with the current lockdown in Shanghai due to the rising COVID-19 cases in China. Ladies and gentlemen, after more than 2 years, Indonesia and other global partners are still combating the COVID-19 pandemic. Nevertheless, the economy has started to recover due to social restriction measures, extensive vaccination effort, and various government policy makes to support the economy. Indonesia economy is still on the path to recovery, as several indicators to the Indonesian business activities, consumption, and investment have shown promising improvement. To maintain this course, support from the financial sector is essential. The supply of credit from the bank would serve as the main funding for economic growth. Therefore, to close my discussion on this session, it is particularly interesting to explore more on the role of financial sector in economic recovery in the webinar. And more importantly, if we want to recover faster, we have to do it together. Voting Indonesian G20 tagline, let's recover together and recover stronger. Thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you very much, Mr. Didik Madiono, for such a very comprehensive explanation. We start with the global condition of the economics, and then we continue to discussing about what the Indonesian have now, and then he also provided us information about the program that the IDIC have, and also the further challenges that will be faced in the near futures. And I'm pretty sure that if you have any question, feel free to fill up your question in the chat box for all of the participants, because in the webinar session, we will have a question and answer session. And I think it's a good opportunity for us, after we hearing the keynote speech from Mr. Didik, we will have a virtual photo session along with the speakers and also the participants. So I would like to invite and humbly invite all of the speakers and the participants to open the camera up, as we will have the virtual photo session together this afternoon. So please. Perfect. So I can see all of you. It's very clear and very nice this afternoon. So let's have a big smile today and have documented our session today. So in count of 3, I guess, committee, 1, 2, and 3. And once more. Probably we will have like the thumbs for us today. So everyone, would you please to give your thumb for today's webinar? So, okay. 1, 2, and 3. Perfect. Thank you very much to all of the speakers and also the participants. And let's proceed to the main agenda of today is the webinar in the financial institution and economic recovery for the global perspective. And today we will have like 5 notable speakers that will deliver the material to all of us this afternoon. We have Professor John Williams from University of Bangor, UK. And then also, good morning, Professor Williams. So, good morning. And then we have Professor John Wilson from University of St. Andrews. Good morning, Professor Wilson. And then we have Professor Ahmed Farouk Aisan from Hamad bin Khalifa University, Qatar. Very good afternoon, Professor Aisan. And we have Dr. Ruth Takneng from Université de Limoges, France. Good morning, Dr. Takneng. It's good to see you. And then last but not least, we have Dr. Aldi Faris Asanta from Universitas 11 Maret, Indonesia. Ladies and gentlemen, so this webinar, we will have 5 speakers that will be delivered for each around 10 minutes. And in the last session of the speakers, we will have a question and answer session. And so feel free to fill up the question into the chat box, and I will try to bring the question into the discussion session. So without further ado, let's proceed to the first speakers for today. Professor John Williams from University of Bangor, UK. So before that, I will read out some brief introduction of Professor John Williams. So ladies and gentlemen, Professor John Williams is a full professor of banking and finance at the Bangor University and also a visiting professor at the University of Turin, Italy, and the University of Malta and Zhuhai, China. He also a co-director of the Institute of European Finance and an editor of World Banking Abstract and the chair of the European Association and the tutor of Banking and Finance. Without the further ado, so let's proceed to the first speakers for today. So Professor John Williams, can you hear me?
Yes, I can do, Auntie.
So it's always good to see you. So please, Professor, platform is yours.
Okay, thank you. Let me try and share my screen. Can you see my screen, everybody?
Yes, for now it's perfect. Would you please to put it into the slideshow, in the full show mode, please? Can you do it or?
Okay.
Okay,
can you see?
Perfect now. So please, Professor.
Brilliant. Thank you very much. Well, it's a great pleasure to be here today, this morning, UK time. Thank you for the kind invitation. It's always great to see so many friends from 11 Maret and OJCAP. My talk today is called Why Market Structure and Bank Competition Matter for Economic Recovery. So I'm focusing on a very narrow area. I think that we need to understand how banking market structure and bank competition impact the real economy. And this is important if we are to design and implement regulations that set the right incentives for banks, and also to fix imperfections which have created trade-offs between policy objectives, for instance, between whether to increase competition in banking versus financial stability. And my discussion draws inferences from the extensive academic literature. While the theme of our conference is economic recovery, if we look at the current trajectory of yield curves, then the direction of the yield curve, the inverted yield curve we are seeing at the moment, suggests that a recession might be looming. And the chart shows the yield curve in the US. And what I would like to highlight there is that before every major recession, there is an inversion or a negative yield curve. And that is precisely what we are seeing in the first half of 2022. And that is on the back of rising short-term interest rates, which have been implemented to counter the rising inflationary expectations. The quotation at the top of the slide here is from a book by Raymond Goldsmith back in 1969. And Ray Goldsmith wrote, "One of the most important problems in the field of finance, if not the single most important one, is the effect that financial structure and development have on economic growth." And this study of the finance growth relationship has taxed economists for a long time, but nevertheless, this literature has proven that there is a causal relationship between the level of financial development and economic growth. And consequently, this suggests that policymakers should divide policies which should enhance financial sector developments, be that in the banking sector, the stock market, or other financial markets. And financial institutions and financial markets can contribute to economic growth by improving the efficiency of financial intermediation. And this would include enhancing the screening and monitoring functions in order to reduce information asymmetries, which in turn would lead to a more efficient allocation of capital and a more efficient use of the capital stock. Notwithstanding that, we noticed that the level of financial development varies across countries, as illustrated by the rather oddly shaped map of the world on the right-hand side of the screen. And what we know from the literature is that financial development follows a similar pattern across countries, albeit at different points in time. And as countries move, or as countries get richer or move from poorer to rich, financial institutions' share of GDP increases in a process called financial deepening. Private-owned banks become more important in allocating credit vis-a-vis the central bank. Non-bank financial institutions develop alongside banks, and stock market share of GDP also deepens. And a deeper financial sector widens firms' access to credit, which in turn feeds through to higher growth rates. And this slide shows or summarizes some of the empirical evidence which proves this point and proves that, that there is a financial engine of growth. But how does banking affect the real economy? And which specific features of banks and banking industry matter most for the real economy? These are important questions, and my focus today is on bank competition. And specifically, regulators are charged with trying to increase competition in financial markets and sectors like banking in anticipation of expected efficiency gains and also consumer welfare gains. Therefore, a leading question is whether bank regulators should increase competition in expectation of better loan terms and better access to credit, which we know will have positive impacts on economic growth. And while there is some evidence from the US following the Reagan-Neal Act of 1994, which suggests that deregulation can increase the amount of available credit, theory has a different proposition. And theory suggests that banks require a degree of market power. This is the ability to set price, really. And banks need this degree of market power in order to have the right incentive for banks to screen and monitor their borrowers, which will reduce uncertainty about the quality of firms and entrepreneurs. Of course, this leads to possible scenarios. If banks can't capture the firm over time, then if the firm becomes successful on the back of bank loans, the successful firm could seek better terms from competing banks. And those competing banks would not incur any additional screening or monitoring costs should the firm decide to switch banks. And this implies that in competitive markets, banks must price loans according to the intrinsic risk of entrepreneurs. However, if a bank is allowed a degree of market power, the bank can offer better initial terms if the upfront costs can be recuperated later in the bank-firm relationship. The implication here is that firms could have better access to credit in relatively more concentrated or less competitive markets. And another inference is that too much competition might lead to development traps. So does it matter whether the market structure of the banking industry is unconcentrated, that is akin to perfect competition, or if the inherent market structure is concentrated, with a few large banks exercising market power, for example, as in oligopolistic competition? Some of the empirical evidence suggests that there are two main results to this question. And these results support both sides of the debate. The first result suggests that bank concentration adversely affects economic growth. It implies that greater concentration leads to lower levels of credit in the economy as a whole. And the lower level of credit is common across all industrial sectors. And this is irrespective of firms' external dependence upon bank finance. Because we might suspect that because industrial sectors vary in their dependence upon external capital from banks, that bank competition might matter more for sectors that are more reliant on bank finance. The second result from this literature tells us that the effect of market concentration is heterogeneous. It varies across industries. And specifically in industrial sectors where younger firms are more dependent upon bank finance, market concentration exerts a positive effect on growth. And the effect here is large enough to offset the first negative effect. And what this tells us is that if regulators allow banks a degree of market power, then banks through this market power can facilitate lending relationships. And it's these relationships which enhance firms' growth. There are further considerations, specifically the trade-off between competition and stability. And this is important due to the effects of regulation on financial developments. Should policymakers further deregulate banking and financial markets? Or to put the question another way, is too much competition good or bad from a financial stability perspective? So we present some hypotheses on the slide here. If there are higher levels of concentration which allow banks this degree of market power, what we tend to find is that in such environments, bank profitability is higher. And if banks enjoy a nice level of profit, this creates an incentive for banks not to take excessive risks, which in turn reduces the probability of systemic risk. However, if banks do exercise their market power, and if banks charge higher loan rates to borrowers, this will increase the cost of working capital for those borrowers and increase the probability of corporate defaults, which in turn raises the possibility of systemic risk. At lower levels of concentration, that is, in a more competitive environment, competitive pressures can reduce bank margins, which in turn would reduce bank profitability. And this could incentivize banks to undertake riskier behavior, which would raise the probability of bank failure. So what is the effect of greater competition on banking sectors? Well, the empirical evidence draws a distinction from what is found in developed countries and what is found in developing countries. In developed countries, banks which exercise market power face higher loan portfolio risk. So charging higher loan rates does feed through into lower portfolio risk, and this is significantly higher risk. However, those banks are able to counter this rise in loan portfolio risk by using their charter value to hold significantly more equity. So while banks are taking more loan portfolio risk, they are capitalizing themselves in such a way which reduces overall risk. However, in developing countries, the results are more mixed. In developing countries, a higher degree of bank market power is associated with higher levels of bank stability, which would suggest that banks are making a relatively reasonable level of profitability, which is an incentive for banks not to take excessive risks. But the fact that we have two results here, or two, suggests that the competition stability relationship is actually U-shaped. And of course, when we come across U-shaped relationships, this is going to complicate, or can complicate, the setting of competition policy. So I'd like to bring my talk to a close just by presenting some key data for Indonesia and the UK in 2006 and 2020. Just some of the variables which are from the finance growth literature and some banking system indicators as well. So I'd like to thank you for your time, for your kind invitation. Happy birthday to Universitas 11 Maret. Thank you very much. All the best. Bye-bye.
Thank you very much, Professor John Williams. What an interesting presentation on We Can See Day. There is no a single result on how we can talk about the, for example, the banking structure and the economics, and then the competition and also the stability itself. And I'm pretty sure a lot of questions are in mind of the participant today, so feel free to put your question into the chat box and we will discuss more into the question and answer session. So, ladies and gentlemen, let's proceed to the second speakers for today. We will have Professor John Wilson. So, very good morning, Professor John. And let me read out some of the brief of the introduction of yours. Ladies and gentlemen, Professor John Wilson is the director of the Center for Responsible Banking and Finance based in the University of St. Andrews. He is also the member of Scientific Advisory Board at Chartered Association of the Business School Academic Journal Guide, and previously he was the treasurer at the General so a lot of a big position that held by Professor John Wilson. So without further ado, let's hear out another perspective on this today's webinar. So Professor John, so please, the platform is yours.
Okay, thank you everyone, and thank you for the invitation. So I think what I would like to do really is to perhaps sort of complement some of the discussion there provided by Professor Williams, and really to, I guess, provide a sort of broader brush, maybe perhaps a quite speculative discussion about where we actually go in terms of sort of banking research in the aftermath of COVID-19. Now, you know, we know that from history that when something bad happens to the economy or even to the financial system, it normally has quite long-lasting implications. So the famous sort of crash of 1929, where we saw financial markets crash leading to a Great Depression and widespread bank failures. We saw a global financial crisis in 2007 to 2009, which was accompanied by bank bailouts and sovereign debt crises. And we also saw lots of austerity programs being imposed by lots of government around the world. And we were left asking ourselves quite a lot of questions around whether the financial system had in fact become too large and perhaps didn't convey the sorts of benefits that Professor Williams has outlined in his talk. And we were left asking whether banks had become too big to fail. And we were also left asking a fairly basic question that perhaps we'd forgotten about in some of our research, which is how important are banks to the functioning of the real economy? So we were left to really explore these issues where there was a sort of paucity really of research evidence. And we really were trying to grapple with issues about how financial system shocks transmitted through banks, through the financial system and onto the real economy, and trying to understand quite complex interconnections between governments and banks. Now, it's probably fair to say that as academic researchers and policymakers, we did to some extent rise to that challenge, and we have seen improvements in data and econometric research designs which have brought new opportunities to investigate and understand the behaviour of banks, the behaviour of banks and the interconnections between banks and the real economy, and more importantly, really trying to make sense of whether policy interventions made by governments and regulatory authorities had the desired consequences on banks, corporates, SMEs, and households. Now, prior to the pandemic, the COVID-19 pandemic, it's probably fair to say that banks were in a stronger financial position compared to the global financial crisis. So we'd seen a period of extensive regulatory reforms, and banks tended to have higher levels of capital and more liquidity than they had prior to the global financial crisis. But really, the COVID-19 crisis, of course, is really an unprecedented economic shock, and it's led to much faster, more significant public policy interventions than probably any other economic shock we've ever seen. So we've had regulators instructing banks to not to pay dividends, not to award bonuses. We've seen banks granted relief on various regulatory requirements. We've seen central banks engaging in sort of continued quantitative easing. But despite all of these sort of interventions, and often where banks are even being used as conduits for distributing government-guaranteed loans to firms, we're still seeing in some jurisdictions increased credit defaults by households and SMEs, a growth in so-called zombie firms, potential threats to financial and banking stability. So really the global recovery is potentially that we've been talking about for the last 6 months is set to perhaps decelerate markedly amid all sorts of complications around flare-ups, diminishing policy reports, lingering supply bottlenecks, and of course conflicts in Eastern Europe. So what we're looking at with the COVID-19 crisis is something very different. So far, we've looked at a very steep recession, but it's been relatively short. We've seen recovery taking place quite quickly. And to date, we've seen very little impact on the banking sector. Now, going forward, of course, we face challenges that banking research tends to be backward looking. As economists, we're incredibly good at making sense ex post of what has happened previously and providing some rationalization for this. But of course, the situation we find ourselves in now is that lots of things continue to happen in amongst this quite significant exogenous shock that we've seen arising from COVID-19. Now, banks themselves seem to be doing okay, but of course, if the economic situation continues to deteriorate, we could see things change quite markedly. And there are evidence that banks are exposed in some high-risk areas. Now, all of this opens up challenges, But I would argue that we're in a much stronger position 10, 12 years on from the global financial crisis relative to where we were then. We now have much better, fairly standard approaches to research designs, which allow us to properly interrogate hypotheses which try and disentangle the impacts of big shocks on the banking sector or the real economy. And we often do this in single country settings so as to allow for or to sweep away potential problems of differences in language and culture and law that we see in a lot of cross-country studies. So what do we know so far? Well, there's been a lot of literature come out in the last 2 years, some of it quite good, some of it perhaps rushed. And we can see why researchers have done this. We're trying to make sense of a situation as it actually evolves. And we've seen that banks are changing. So there's some evidence that business models are adapting, and perhaps trends which we saw prior to the financial crisis and even prior to the COVID-19 crisis are continuing to accelerate, particularly around technological change and so on. We are seeing that banks have actually played a very important role when being faced with increased demands for credit like they've never seen before. So banks have really been very useful in alleviating lots of liquidity constraints and liquidity pressures facing firms. And particularly, banks have played an important role in keeping lending going to small businesses who perhaps lack alternative forms of finance. So it's fair to say that bank lending has tended to continue quite well in most countries throughout the crisis, and in large part due to official government support measures. And also banks have increasingly been seen as a safe haven. So banks in many countries have experienced massive inflows of deposits during the COVID-19 crisis, which of course have placed them in a relatively good position to fund future lending. And of course, we may expect to see going forward increased instances of bank misconduct, financial mis-selling, financial misbehavior, because we often tend to see these things during crisis periods. So this is something that I suspect we might start to see going forward. The role of fintechs, of course, is really being emphasized much more, that they, in some countries at least, seem to have played a very important role in filling any gaps left by traditional financial intermediaries, particularly in lending to small businesses. And so we've got this evidence base, and we've also got some broad brush overviews of where the research currently sits on banking in a sort of COVID-19 environment. And we've got a bit of a sense of which policies have been used, and to a lesser extent, a sort of sense of whether these have worked or not. So what next? Well, we've got this emergent evidence base, but of course, we're only beginning to understand if or how banks have weathered the COVID-19 crisis and how they will affect or even be affected during any recovery phase, or perhaps even a phase of relapse, depending on what happens in the world economy. So we need to try and understand bank exposures to high-risk corporate borrowers. We need to think about where liquidity shortages might occur and where they might impact on banks. We need to think about which types of firms banks are cutting lending to when times get tough. We need to think about the interconnections between the financial system and the real economy, and firm-level decisions around investment and HR and human resources. And we need to really think about spillover effects of disease incidents or even vaccines, and how positive or negative shocks play out in the financial system. And I guess most importantly, we need to understand going forward for the future how public policy interventions impact bank behaviour and resultant interactions with other stakeholders in the economy, so depositors, borrowers, shareholders, and debt holders. So as a final thought, really, it's very difficult to predict how COVID-19 has impacted the banking industry and banking industry research, at least in the medium term. And the shocks this time are very different from those we experienced during the global financial crisis in the sense that they are truly exogenous and they tend to be much more demand-side related. So we do start from a stronger position than during the global financial crisis as researchers in terms of assessing the possible impacts of banks, households, SMEs and corporates. And our data sets now are much better than they were over a decade ago. We've got real-time surveys taking place. We've got real-time sort of scanner level data sets, which allow us to observe things as they actually unfold over time. And of course, our econometric tools have improved vastly. We have an armory of difference in difference techniques, regression discontinuity designs, propensity score matching algorithms. And all of these things make our research designs much more robust than they ever were before. And so any relationships that we do uncover are perhaps causal rather than illusory correlations. So answers to these questions really via academic and policy related research using better data and cutting edge research designs are really going to play a crucial role in how we understand how this COVID-19 crisis has played out in the financial system and in the real economy. And of course, that's going to be very important going forward for what we do in any future crisis related events. So that concludes my talk, and thank you again for the invitation.
How the future research in banking will be affected into the near future due to the COVID-19, and we can see that Professor Wilson also provide us various of research post the COVID-19, and also we can see one of the paper working on the fintech regarding in the influences in the banking industry itself. And ladies and gentlemen, without further ado, so let's proceed to the third speakers for today. We will meet the Professor Ahmed Farouk Aisan, a professor at HBKU, Qatar. He is the full professor at the Hamad bin Khalifa University, Qatar, and also the PhD director of the Islamic Finance and Economic Program. Professor Aisan has been the board member and monetary policy committee member of the Central Bank of the Republic Turkey, and also served as the consultant in the various institutions such as the World Bank and the Central Bank of the Republic Turkey and the Oxford Analytica. So without further ado, let's proceed to meet Professor Ahmed Farouk Aisan. So very good afternoon, Professor.
Good afternoon.
It's always
nice
good
to see you all. It's great pleasure
Yes.
to be with you.
Yes.
Congratulations, first of all, to UNS for the 48th anniversary. And thanks to Deposit Insurance Fund of Indonesia for being part of it. And also thanks to all the participants, our professors, John Williams, John Wilson, and the keynote speakers. It was, and Ruth, I haven't listened to her yet, but I'm sure she will also talk on interesting topics. And also I would like to congratulate G20 Indonesia for having the G20 presidency again after a very short while. Indonesia is having the G20 presidency in the second time in the last 10 years, as far as I remember, and especially at very difficult times and very important times for the global agenda. So I try to follow the G20 meetings in Indonesia as well, with some implications. So I'm sure Indonesia will also put a stamp on the G20 meetings. So it is great that this event is also being done as a part of it. I I have one presentation. But my presentation will be mostly on the two parts, which the first part will be mainly talking about the global implications of the global recovery. As it is stated, how do you see it? By the way, let me end the slideshow and let me reshare it. Okay, how do I share it? It is already like this. Okay, I guess display settings. Okay, this is better, I believe. I want to first talk about the global implications of the post-COVID-19 circumstances, and then I will talk about the implications for the banks. I would like to start with some observations. First of all, it is probably even a tougher period in the post-COVID episode right now, because when the first post-COVID comes, it was a natural crisis, and everybody knows that we have to take actions. And even the reason of why G20 has been established as this one is to increase the global cooperation, and especially to coordinate against global natural crisis is an easier one. And as we observe, many central bankers, policymakers know what to do. After a while, they learn that COVID-19 is a global epidemic, and the precautions for mitigating the risk of COVID-19 was simple. I mean, they printed more money, they were careful about their banks for financial stability concerns, and they know that after a while, this will last for a while. Now we are in the post-recovery period. Pretty much the COVID-19 seemed to be mitigated. I mean, it is still there, but it is not as severe as before. Right now, we have still certain unknowns, certain uncertainties, as we will have always. Economists and finance people, we might be a bit more conservative about looking forward to the future. But I believe that this is even more of a problem, because right now, if there is any mistake that we have done in the COVID-19 period, it could be the starting point was not coming from the individuals. It was not coming from the policymakers. So it was a natural crisis, and all the central banks, all the policymakers tried to respond to that through either through fiscal channels or the monetary challenges. But right now it is the recovery, and we use some of our ammunitions against the crisis. Now we have to increase our resilience for similar type of crisis. So the role of the policymakers are even more in the post-COVID-19 recovery period. But there's another problem there. Then the next problem comes when we rely on the individuals, the policymakers. Then they can make the mistake. They may not take the actions on time. There could be delays. They may take over actions, or because of the delay of, for example, not increasing the interest rate, there could be even hyperinflationary periods. And actually, we are observing that somewhat. Right now, the major discussion is in the global markets is rising inflation. In US, the inflation rate is even in the production indices, it is even more than 10%, but in the consumption price indices is about 7%. Same thing in Europe. I mean, even Germany has more than 7% inflation rate announced recently. So all the countries, regardless of whether developed countries or developing countries, actually they are facing this global inflation problem. Under normal circumstances, and this is somewhat expected. Why? Because in the last 2-3 years, all the central banks have pumped money into the economy. There were fiscal expansion, and all this new monetary policy theories have been actually disregarded right now, because we realize that there could be an inflation. It is not new monetary policy, but inflation can come back. We learned this, especially over the last 6 months or so. So inflation is right now with us, and it is an easier game. I mean, the academia, central bankers know how to handle inflation from the historical data points, from the historical evidence. It is easier. But the problem is that how fast we should be. And there are other constraints. If we act very quickly, we can contain inflation, but it comes with certain risks because we have been treating the economy with medicines, with injections, and so on for a couple of years, and we don't want to wake up the patient immediately, right? The global economy was like a patient, and we don't want to wake up this patient immediately and try to reduce the inflation very quickly. But if you don't do so, there should be a right balance, and it is very difficult to achieve. And look what is happening right now. I mean, Fed, ECB, all the major developed countries are facing this problem, and same thing for the developing countries' central banks, because they are one way or another somewhat the policy takers of the monetary policy from developed countries. And it is still a big issue. I mean, there is 7% inflation rate, and we are still in the process of tightening. How fast this tightening should be, when the Fed should start raising the interest rates, this is a big issue. And again, I would like to emphasize this, it is open to human errors. I mean, you can make mistakes at the beginning of COVID-19, probably it will be internalized because the major natural shock, and then you have more degrees of freedom to make mistakes. But in here, any mistakes that the Federal Reserves or any central bank does, it will have long-term consequences. And certainly this will have certain implications for financial institutions, especially for the banks. It could be good for the banks because we know that after 2008 crisis, the banks were relatively underperforming. They have profitability issues. They have issues related with the financial stability concerns. Now, in a higher inflation environment, they can have higher net interest margins, they can have higher spreads. But we don't know that because there is at the same time high competition. And the competition this time is not just within the banking industry. Competition is coming from the big tech companies and from the small fintech companies. And there are certain unknowns in that regard as well. In addition to this regular inflation problem and the possibility of increasing the interest rate, also global tension came up. Recently, between Ukraine and Russia, the war is going to be probably even postpone this interest rate hikes or the monetary policy tightening, which again will make the patient to be at the hospital for a while for treatment for a relatively an extended period of time. Also, there are still uncertainties about the COVID-19. It is not completely over. But certainly policymakers will start implementing new policies in the recovery phase, and we don't know them. And there are issues, more important issues like energy and food security issues. Right now, for example, people do not care. I mean, the countries do not care about where they are going to get their energy or what will be the price of the energy, but they are more concerned about the energy safety. I mean, energy security issues. Same thing for the food security. There is a global inflation, but the global inflation is even higher for the food related products because of the war and because of the general post-COVID-19 circumstances. And there's a huge discussion on the reinventing the Bretton Woods. I mean, the Bretton Woods institutions may not be functioning as they should be functioning. And the US is increasingly using its hegemonic power to impose sanctions to Russia, and it is an example. And this is also a threat to China probably after a while. It could be a threat to other developing countries. And increasingly more we start seeing that this international sanctions, financial sanctions started to be used in the global scale, which might lead to some other complications later on. I mean, we don't know it yet. Still, there is a huge issue about the global inequality with the rising food prices and so on. Supply chain issues are not still resolved. And at the same time, we are dealing with the sustainability, and there's a much more emphasis for ESGs, issues related with sustainable development goals. And especially these issues have implications for the banking industry. But overall idea is that resilience seems to be the key concept rather than just the profitability, growth, development issues. Resilience of the countries, resilience of the banks seem to be even a major concern. When we come back to implications at the more micro level for the banks and for the deposit insurance corporations as well, first of all, we should accept the fact that even without the COVID-19, banking was in transition. Banking was in a kind of a structural in a phase of structural transformation because of the rise of the fintech companies and big tech companies. There are lots of new products, mostly provided by the fintech companies in terms of crowdfunding, payment systems, and so on. And the banks are increasingly becoming more of platforms rather than, or the service as a provider companies rather than the very traditional banking companies. This has implications for the competition, and this has implications for the financial stability. Increasingly more, we observe merger and acquisition, and the COVID-19 is a good excuse for the banks to merge, for the relatively less performing banks to be bought by the other banks, and for further consolidation. We are observing it in the Middle East, in Qatar, in the region, and also globally. This is the case. But this definitely has certain financial stability concerns. I mean, we don't know how to regulate the fintech companies, really. I mean, the fintech companies are relatively new. We know a lot about how to regulate the banks. We have BIS 1, we have Basel 1, Basel 2, we have BIS, and there is much more global coordination among the countries in terms of regulating their banks locally and internationally, but we don't have similar rules. And it is much more difficult to write rules for the fintech companies. And sooner or later, it will have certain financial stability considerations. And the most immediate consideration is for sure related with the cryptocurrencies. There's a huge market now, more than $3 trillion. It is quite sizable amount. And within the cryptocurrency market, there are, for example, stable coins. Stable coins are provided by certain companies, and they are, in a sense, having a seigniorage revenue from issuing stable coins. But who's backing them? Are they really having backup for this stable coins, or it is more of a gambling, especially for stable coins? And these concerns have been raised by the US Treasury, and they also know that it is not easy to solve this. They cannot immediately ban cryptocurrencies. They cannot immediately ban stable coins because they are not located in US, and there are certain limitations that if they act very quickly, they might even lead to triggering a crisis. So they seem to be quite cautious on this, and because it is very difficult, really. And there are lots of issues. Anti-money laundering related issues are being used like threats also. There are sometimes issues, but it could be also used against certain countries as threats. Cybersecurity issues, there are much more of the activities, financial activities taking place in the digital realm, and the cybersecurity issues are with us. But in spite of what happens after COVID-19, the digitalization will be with us. And this will affect all the banking structure, marketing approach, customer outreach approach of the banks. We will see more banks in the metaverse, probably. There are some companies, some banks start offering their products in the metaverse. And this is at the agenda. Before my presentation, I was also looking at the G20 agenda under the presidency of Bank Indonesia. In the finance track group, there are similar groups like Framework Working Group for the International Financial Architecture, Infrastructure Working Group, Sustainable Finance Group. So these are good topics for the academics also to work, because these are at the top of the agenda of the policymakers. Even at the sharper levels of the G20, digital economy has been around with us since 2016. G20 ministers are discussing digital economy implications, and certainly one of the most important digital economy implications is the banking. And related with that, I believe in order to be more forward-looking, these cryptocurrencies will be with us, and digital forms of banking will be with us. open bankings will be with us. But more importantly, at the infrastructure, we will start observing more central bank digital currencies. Right now, we don't have central bank digital currency, but I propose that central bank digital currencies can be used as global stabilizers. And it could be used more for the reinventing the Bretton Woods and empowering some of the existing institutions. I know I'm running out of time. I will not get into details, but just to show, many countries are involved in the central bank digital currencies. Apparently, I mean, they will not completely ban cryptocurrencies, and instead they will complement it with the CBDCs. Countries have in different stages, and Indonesia is also, as far as I know, is one of the Indonesian central bank is also making research on these issues. There are certain benefits and certain drawbacks of central bank digital currencies. I am more concerned about not the benefits, but the drawbacks. The main benefits on the payment system, the financial infrastructure will be faster, more efficient, I mean, more regular stuff. Monetary policy probably will be easier to implement. This is very important, especially after 2008 global crisis. But there could be certain drawbacks, especially for developing countries, and especially for deposit and saving insurance corporations. When more and more people start using cryptocurrencies and the government start implementing central bank digital currencies, it will be much easier to have bank runs, because the markets will run 7 days, 24 hours. For any small incremental news, some sentiment related news, people may start withdrawing their money from the banks. And I believe deposit insurance companies should work on this. I mean, what will happen if we adopt central bank digital currencies? What will be the implications for the bank runs? If the markets start operating 7 days, 24 hours, are we going to be able to closely follow the markets? And there are different CBDCs form, for sure, but this is a major concern. And also there could be capital flight. It is not just keeping the money within the country, but also through the CBDCs, just in seconds, money could be, the funds could be transferred from one country to another. And especially developing countries are more likely to suffer from this, because their financial system, financial markets are not well developed, and they are more open to speculations. They are more open to the changes in the sentiments. I believe this has to be taught more. And that's why there are some surveys, for example, done at the advanced economies and emerging market economies. Certainly there are like 6 main dimensions, like the CBDCs could be used for payment, safety, robustness, for efficiency, for financial stability. And it seems to be that all countries are quite concerned, but especially for the financial stability, they are both concerned, developed countries and developing countries. There could be certain benefits of the CBDCs for sustainable development goals, for sustainability. It depends how we are going to be using this CBDCs. But let me stop here, with concluding that resilience will be even more important, and financial technologies, we should even work more, not just on the fintechs per companies, but in terms of the financial, global financial infrastructure. How can we strengthen the Bretton Woods institutions through digitalization, through central bank digital currencies? I believe this is also a very important agenda that we have to think in the post-COVID period. Thank you very much for giving me this opportunity.
Thank you very much, Professor Aizen. Another captivating material delivered by Professor Aizer, and I personally believe that it could add on and a complementary for what has been delivered by another true professor, Professor Wilson and Professor Williams. And let's proceed to the fourth speakers for today, one and only female speaker for today. So let's meet Dr. Ruth Tahning. He's the faculty member at the Faculty of Economics and Law, University de Limoges. Her research domain is in financial economics and development economics, and her research interest in the inclusive growth, fintech, financial stability, institution experiment and ethics. It has a lot of publication and also a prestigious projects. Some of them is the Kali Bank and also the PHG Hisbicus collaboration with the Malaysia, and also the Erasmus PT Bank collaboration with the Indonesian partners. So very good morning, Dr. Takneng.
Good morning, Dewanti. Can you hear me?
Yeah. So please, Dr. Takneng, platform is yours.
Okay, so I'm sharing. Can you see it properly? Yes.
Now it's perfect.
Okay, so first of all, I would like to congratulate UNS in collaboration with Indonesia Deposit Insurance Corporation for organizing this webinar, and thank also Professor Trino Groho for inviting me to participate and speak in this webinar. So my presentation today complements the discussion already made by Professors Williams, Wilson, and Aisan. I'm going to focus mainly on some selected policies and responses to COVID-19 with special focus on France. Okay, so regarding, first I'm going to discuss about the TRO3 package, and then the French state guaranteed loans with some variants. They're not COVID variants, but in response to COVID-19. So we have the PGE CESO, or state guaranteed loans directed to specific sectors such as tourism, etc. And the PGE resilience, which is a keyword by Professor Aisan a while ago. And later on, I'm also going to discuss about the issuance of social bonds in order to finance policymakers comprehensive packages. Okay, so as highlighted by the ECB president, the public policies cannot prevent economic activity decline, but they must ensure that the downturn does not persist and go deeper than they need to be. So as highlighted a while ago also during the keynote speech, monetary policy has a vital role. Of course, this is in conjunction with fiscal and health policies. So what's the main role of, what are the main roles of monetary policy? First is to keep the financial sector liquid and ensure supportive financing conditions. The problem with tightening financial conditions is that together with constrained private spending, it could have threats to price stability. So one of the instruments that are undertaken or were undertaken by the ECB are the targeted longer-term refinancing operations. So it's not new. They have been already launched, for example, in 2014 and 2016. But the third one, it's catered more specifically to address the COVID-19 effects. Of course, although it was launched before the pandemic, it has since been adopted, for example, by offering much more favorable rates than the previous versions of the TLRTOs. So what are the TLTROs? Okay, so first they are targeted. So they are targeted at maintaining or increasing bank lending to businesses. So what happens here is that the ECB is able to provide banks stable and dependable funding so that they can pass on the money to businesses and households. So it's conditional. It's conditional because banks are able to only take advantage of favorable rates if they actually lend to businesses and households, except for home purchases, of course. And they are longer-term loans. They have to be paid back after 3 years. So this is a certain particularity compared to the previous versions of the TLRTOs. So right now, banks can borrow funds from the ECB for as low as 50 basis points less than the ECB's deposit policy facility rate. This is more favorable than the TRO2 because before it's banks could actually contract credit at the ECB's deposit facility rate, but now it's of course more favorable. So now focusing on France, this has been mentioned already a while ago. The presence of credit guarantees, which are instruments employed by several countries. Actually, according to an IMF Desk Economist survey, 39 out of 44 countries actually offer pandemic-related guarantee programs. So what's the objective of these loan guarantees? Of course, it's to help firms obtain loans to address liquidity and working capital needs. It's a borrower support measure, much like debt moratoria and deferred bankruptcy proceedings. They have coverage ratios of 70 to 90%, which are high enough to incentivize banks to extend loans while mitigating moral hazard risk. So government guarantees do not carry high capital costs for banks. A recent study, 2021 by IMF, actually show that supportive policies help mitigate the impact of the crisis on bank capital. So what is the SGL or the Pré-Garantie par l'État offered in France? First, they are offered by banks and also by crowdfunding platforms to support the cash flow of businesses affected by COVID-19. It has been launched in March 24, 2020, but has since been extended several times. Now it's until the 30th of June 2022. So they're not automatically extended. So the banks, of course, still reserve the right to reject state guaranteed loans. So what happens, for example, to some firms who are not able to take advantage of this type of loans? So, for example, for France, an alternative financing solution is a direct loan granted by the state, but of course the rate is a bit higher, but the duration of amortization could be longer. But this one is a specific type of aid that the government offers. So the SGL can account for 25% of the business total revenues or turnover in 2019. There are specific conditions and caveats, of course, especially for those firms that were established after 2019 and innovative companies. They are granted for a period of 12 months, no repayment required in the first year, and there's the option to amortize loan over an additional period of 1 to 5 years. So just recently, there's a directive from the Ministry of Economics with special consideration, proposing special consideration for very small enterprises that are very much affected or hard hit by the crisis, deferring further the amortization for up to 10 years. So a while ago, I discussed about crowdfunding platforms being able also to provide state guaranteed loans. So, for example, October, a fintech company based in France introduced what is called as instant projects to better support SMEs during the crisis. So it announced in June 2020 its use of a decision algorithm called Magpie to evaluate these projects. So compared with the traditional credit analysis, which involves local credit teams, inputting information from annual reports and other resources in a scoring model. So the Magpie actually is a tool that allows them to make credit decisions almost instantly. So it's 20% quicker, and of course, the ultimate goal is to be able to distribute more loans. But in the meantime, of course, only French instant projects covered by state guarantee are open to retail lenders. So what is the rate of state guaranteed loans? So it depends actually when the loans are going to be repaid. It ranges from 1 to 2.5%, including the cost of the guarantee. So as highlighted a while ago, as with other guarantees offered in the EU, the scope of the guarantee is between 70% and 90%, depending on the turnover and the number of employees or the size of the firm. So there are different variants. So there's the state guaranteed loan saison for those who have seasonal, of which the nature of their activity is more seasonal. For example, tourism, etc. So it's integral actually to the tourism recovery plan. The advantage here is that they use a different threshold. Instead of the 25% in the classic version, they calculate it as a total of the best 3-month revenue or turnover in 2019 up to 80%. And just recently, in April 8, 2022, there's also what we call as the PGE resilience for firms affected by the war in Ukraine, which covers up to 15% of the average annual turnover over the last 3 years. So firms have to certify to their bank on a declarative basis that their cash flow is directly or indirectly affected by the war in Ukraine. So here are just some statistics of the SGL extended in France. So as of December 2021, around 143 billion euros have been extended to almost 700,000 firms. It's largely dominated by the commerce sector, around 23%, and of course 52 billion, or around over 30% in the Paris region. So here are just some preliminary statistics. So by the end of 2021, 11% have been already reimbursed, and more than half were deferred for an additional year, according to the French Treasury. So very small enterprises and SMEs represent 99% of the beneficiaries, which is equivalent to 77% of the amount of PGE extended. The average loan is 180,000 euros. 77% of the beneficiaries, or most of the beneficiaries, actually received loans less than 100,000 euros. Only 48 large firms were granted a PGE. So there are some critiques regarding the purpose of the loan. Okay, so some are skeptical regarding maybe the firms use the loans for other purposes. But of course, others have argued that the loans have helped them to avoid the economic downturn and facilitated their investments. So a survey conducted by the BPI France, so BPI France is a French public investment bank. In itself, they have actually conducted or established a lot of different measures to respond to COVID. And of course, there's also Rexecode as organizers of this survey. So what they found out was that 48% of the surveyed firms used state guaranteed loans as liquidity reserve, 47% to finance working capital, 21% to repay existing loans, and 14% for investment purposes. A later survey in November 2021 on the borrowers actually showed that 52% declared using less than 50% of the loan, whereas 29% have indicated that they have almost completely used up their loan. So some other statistics. So the rejection rate, as I told you a while ago, they are not automatically extended. The banks still reserve the right to reject them. So the rejection rate was only 2.9% according to the French Banking Federation. So one important result from the French Treasury is that while the beneficiaries' debt increased, because of course this is a concern that the state-guaranteed loans could increase some over-indebtedness, but they remarked actually that the firms, while they increased their debt, they also increased their cash flows. So they indicated that the median weight of debt in liabilities increased by 5 percentage points, but the median share of cash or liquid assets as a percentage of total assets doubled from 12% to 24%. State guarantees do not eliminate, of course, the default risk, but reduce it. But in the meantime, it's still probably too early to tell what could be the impact of these measures, because of course, for example, in France, some firms can further defer the amortization of loans. And as indicated a while ago by Professor Wilson, there could be several research design challenges that we could that we are confronted in order to evaluate their impact, because sometimes there are policies and then there are also complementary policies together with other policies that are altogether happening or being established or implemented at the same time. But a priori, the Banque de France indicated that there are no concerns, or a priori no significant concerns about firms' repayment capacity. Only 5% of the firms think that they will have difficulties to repay, which is estimated to be 4.6 billion euros, but a net only of around, not only, but net of 1.4 billion euros, as the state also generated commissions from the state guaranteed loans. So this is actually my last slide. So I'm also going to discuss briefly about social bonds. So what are social bonds? Social bonds are actually vital to help finance comprehensive packages set out by policymakers in response to the crisis. But more so, social bonds are actually bonds that help finance some projects that tackle social issues. For example, to support employment, provide targeted financial support, alleviate financial pressure on healthcare systems, and finance medical equipment, among others. So who are the issuers of COVID-19 response bonds? Most of them are government agencies like national development agencies. So the first issuer is the IFC, International Finance Corporation, which is actually focused on funding COVID-19 relief measures to the market. So as of now, the volume is lower compared to green bonds, but they are slowly emerging So BNP Paribas, the largest French bank, has supported clients to over $59 billion dollars of COVID-19 response funds in 2020. And the driving force behind this is that BNP Paribas is an expert in sustainable finance and debt capital markets. So thank you very much.
Thank you very much, Dr. Takning. I think it's like become a very interesting because the other three speakers talking about a different point of view, and Dr. Takning bring up the point of view how the financial institution and the regulatory in France and the European Union responds the COVID-19 pandemic with some regulation or the policy made, such as the LTRO and then the PGE, and also the Dr. Ruth also shedding a light on the importance of the social bond itself. And let's proceed to the last speakers for today's webinar. Let's meet Dr. Aldi Faris Aksanta from Universitas 11 Maret. So very good afternoon, I guess, Dr. Aldi. So
good afternoon.
Before Dr. Aldi deliver the material, I would like to read out the brief introduction of Dr. Aldi. So he is the researcher at the UNS FinTech Center and also the lecturer at the Faculty of Economic and Business Universitas 11 Maret, and he got his PhD from the University de Lemos. Without further ado, so Dr. Aldi, platform is yours.
Okay, so thank you very much. First of all, I would like to congratulate the UNS and the ITIC for organizing this meeting and event. And so today my presentation is going to complement what Professor Williams, Professor Aisan, Professor Wilson, and Ruth have already presented regarding the economic recovery. So I wanted to bring another dimension that matters also in explaining the financial recovery, particularly in banks, which is the ownership. So we talk about ownership. There is also state capitalism or government ownership, and also there is also family ownership and also institutional ownership. But today we're going to discuss deeper on the government ownership. So background of why we discuss about the government ownership is on the remembrance of global financial crisis 2007-2008 that have led many governments around the world to increase their stake in number of large banks in the developed countries, and mainly because they wanted to to maintain domestic control of a nation's financial system. But it's not only limited to that. Also, the motivation of government ownership present in the economic is also driven also by motive to compensate the possible lack of private capital with sufficient risk tolerance to finance growth, particularly in the underdeveloped area, or to SME, which widely regarded as risky. Also to finance sector, which play an important social role due to the main objective and main motive of the government ownership that is not driven by economic objective, but rather by the non-economic objective. So regarding the motive of the government ownership, divided into two possible hypotheses. First is the helping hand hypothesis. So government ownership are in position to provide a preferential treatment and are unlikely to allow large state-owned firms to face the bankruptcy, meaning that the presence of government ownership brings a lot of benefits, particularly to the minority shareholder, because with the presence of the government ownership, it also brings a more better access to finance, particularly also preferential treatment, in particular to financial firms where the bailouts are much more common, especially for the banks. While on the other hand, the government ownership also might facilitate financing projects that might maximize the private welfare of the politician. It's a common problem of the government ownership around the world, because both by the democratic and dictatorial government, they need to maintain their power. So the way they maintain their power is by reallocating the resources available in the government to maintain their alliance with another party or another ally to be able to stay in power for sure. So to clear understand the impact of the ownership in bank valuation when bank extend their activities, we also investigate the borrowing from ownership. In these cases, we expected to a positive impact from the ownership, particularly in Asia, because Asia, according to Carlson 2002, has a very unique feature comparing to any other countries is because of its pyramidal ownership structure. And also on the family ownership in Asian firms. So first, we investigate whether the borrowing firms also set on the enterprise, because if the borrowing firms also is set on enterprise, there are also possibility to have a bailout for the SOEs. So it means that there will be a twin helping hand effect. Well, also in the privately owned borrowers with the pyramidal ownership structure, they benefit from the group internal resources or from the pyramidal ownership structure, resources from their ultimate owner. So in that case, private borrowers with the pyramidal ownership structure, they most likely to have a lower default risk if the group supported them financially. So this is what is commonly known as the coincidence effect. In that cases, we use the family-owned bank as a benchmark, as they are more likely to engage in the extraction of the private benefit based on the previous results. So we ended up with the equation, how do minority shareholders anticipate being affected by government ownership when banks extend their activities. So in these cases, we try to understand whether or not the minority shareholders expect that the presence of the government ownership in the banks, even though that it might possess a risk of expropriation related to their non-economic objective, they're willing to still invest in that banks in order to in return they receive sort of protection from the government via the expectation of preferential treatment. So we examined the reports of the used and collected data, unique and quoted data, by examining around 550 Indonesian listed firms' annual report, and we obtained around detailed information on 342 loan announcements from 136 borrowers, and we obtained also 24 lending banks amongst 35 that were listed in 2009 and 2014, and we pulled the control change for each year with the control threshold around 10% using the data from BankScope, Bloomberg, and the annual report. So we find that shareholders do not anticipate being affected by the government holdings in the banks when expropriation is at stake. Well, they actually negatively value the presence of the families as the controlling shareholders. But overall, we observe that whenever banks extend their activity by lending to any borrowers, it will be responded negatively by the minority shareholders, particularly for family banks, and those negative reactions are concentrated in banks with higher risk of expropriation. So the baseline findings that we have in the paper was actually for the family banks, the announcement letters are actually negatively related to the extent of the related lending in the bank's balance sheet, while the announcement written for the state-owned banks are not significantly related based on the world test to the importance of the related lending. So we argue that the expropriation effect is mitigated by the helping hand effect from the presence of the government ownership. It means that the minority shareholders in the Indonesian banks, even though they might face a risk of expropriation arising from the government objective in non-economic objectives, they still benefited from the expectation of preferential treatment. We extend also the investigation by dividing between small firms and large firms, because large firms tend to be more transparent and more able to handle their own risk, internal risk, rather than the idiosyncratic risk comparing to the smaller firms. Our evidence also is consistent with the previous evidences that there is a significant reaction for the state-owned banks when they lend to small firms given to their level of expropriation, regardless small or large firms. While put lending to small and large firms from family-owned banks are responded by the minority shareholder negatively. We extend also whether or not if the borrowing firms are state-owned or a privately owned borrower. By dividing the type of ownership of the borrowing firms, we found out that if the lender is actually state-owned enterprises, state-owned banks, and the borrowing firms are state-owned enterprises, the reaction tend to be positive, given their level of expropriation. While the lender is state-owned banks and the borrowing firms is privately owned firms, there is no reaction following the announcement of the lending. While on the other hand, we do not observe any significant reaction if the lender is family-owned banks and the borrowing firms are state-owned banks. While if the lender is family-owned banks and the borrowing firms are privately owned firms, market tend to react negatively given to their level of expropriation. We also extend to have a look on the coincidence hypothesis, whether or not if the borrowing firms are linked to pyramidal ownership or a business group, they may benefit from group internal resources and possibility to be covered up by their own internal group resources. So it's quite similar to our previous finding. When the lender is state-owned and borrowing firms is state-owned enterprises, we still have a positive result. While the lender is state-owned and the borrowing firm is privately owned firms, there is no significant reaction. Similarly, also regardless whether the borrowing firms is a private firms related to the pyramidal ownership or not in the pyramidal ownership, or has a horizontal ownership. While when we try to expand more on the family banks, when they lend to a state-owned, it's still the same. There is no significant reaction. But when we divide it between borrowing firms, private firms that is linked to pyramidal ownership or not linked to pyramidal ownership, there is significant differences. Those firms that are linked to the pyramidal ownership, when the family banks lend money to them, they suffer less negative reaction comparing to the firms, private firms that are not linked to pyramidal ownership. So the key takeaway from the simple research is actually that even though that there is presence of expropriation in the government banks by the presence of government ownership there, the shareholder of the minority shareholder of the government banks, they are still willing to invest on that banks, but in return they expect preferential treatment in case of failure during the lending. So it means that they cannot have a safety net in case of a lending failure in the government banks comparing to family-owned banks that we use as a benchmark. In that sense, also we cannot support the argument that government ownership, particularly in the country with big legal protection to shareholder and creditors, government ownership may bring a benefit, especially by resolving any market failure. Also by providing kind of assurance inside the economic activity in case that the private ownership cannot tolerate the risk emerging from such activity. So I think that's all. Because we have a limited time, I give it back to Dewanti. Thank you.
Thank you very much, Dr. Aksanta, for delivering a quite interesting material on one of his research on the impact of ownership in the bank valuation using the Indonesian data. And as you can see, it's a quite interesting papers, and I'm pretty sure a lot of questions arise about these papers. Ladies and gentlemen, and all those speakers and also participants, let's proceed to the discussion session that we will have discuss a lot of questions that coming from the participants. So I will invite all of the 5 speakers to proceed to the stage as we will have the question and answer session. And the first question goes to Professor John Williams and John Wilson. So the question is coming from Nur Sastren from the UNS, and the question is about do efficiency banks have advantages to achieve financial stability, especially during the pandemic, as the institutional are heterogeneous across the country? So do you get the question clearly, Professor Wilson and Professor Williams?
Sorry, Dewansi, I didn't quite catch it.
Yeah, so do you hear the question clearly, Professor Wilson and Professor Wilson?
We can hear you. I just didn't quite catch the detail of the question.
Yeah, basically the question is about does the bank efficiency help the bank to maintain the financial stability during the pandemic, considering that the bank has a very heterogeneous nature across the country. So please, probably first,
Okay.
Professor Williams.
Yeah, okay. Thank you for the question. I think the evidence in the literature suggests that when we have the relationship between competition and stability, that relationship works through bank efficiency. And efficiency is the main channel through which competition affects stability. More precisely, if banks are more efficient, then they are able to enhance their credit risk management. And it's through that way that the bank becomes more stable. I think the literature provides us with channels through which competition impacts stability, and bank efficiency being a main channel, main conduits of increases in competition. And that evidence is quite robust. It's been found before the current crisis. So therefore, to precisely answer the question would require some analysis of the current situation. But I would assume that the main finding would hold, that competition will encourage banks to become more efficient, and specifically to become more efficient in the way they manage their credit risks. And this in turn has a positive impact on stability. I hope that addresses the question. John, do you have anything to add there?
Yeah, thanks, John. I suppose I always start off with trying to answer a question like this by speculating on what we really mean by efficiency. And I think this is a term that gets bandied around quite casually, I think, in the literature by researchers more than anything else. And I think really it depends what sort of efficiency we're talking about here. You know, if we think about the 3 notions of bank efficiency, so one being this idea that banks might strive to be X efficient. So in other words, given their size, they operate on the best practice production frontier. On the other hand, you know, we might talk about notions of scale efficiency. So in other words, this idea that as banks get bigger, they tend to become more efficient because their average costs decline for a whole range of reasons. They can access cheaper funding, they can avail themselves of big technological investments that feed through to efficiency. And then I guess the final one is this sort of notion of scope efficiency, where this idea perhaps that banks can use, you know, a single input to produce multiple sort of outputs. So I suppose in the and I would agree with John. I don't think we really know enough yet to get a proper handle on this, but I would probably try and speculate that really it's this notion of scope efficiency that's perhaps more important in the context of the COVID-19 crisis, in the sense that this is very related to how diversified banks actually are. And I would argue that the bigger banks who have multiple sources of revenue and are less exposed perhaps to credit risk than smaller banks and less diversified banks are likely to have more sort of efficiency advantages. And I guess also to add to that, if we think of very big banks, they tend to be financial conglomerates. So in one part of their business, they might be struggling in the sense that traditional banking business might be under pressure. So SMEs and households might be struggling. So that might be putting a pressure on their balance sheet. But we also know these huge conglomerates have investment banking activities where obviously a lot of these activities have been relatively profitable over the last year or so, where we've seen sort of spikes in commodity prices and so on. And actually some banks have done quite well in sort of trading and speculating against these. So, I'm not sure I've completely answered the question there. I think I would agree with John, we need probably more analysis, but I would tend to speculate that it is the larger, more diversified banks that have tended to be able to cope better with the current sort of COVID-19 crisis.
Thank you very much, Professor Wilson and Professor Williams, for answering with a very quite a comprehensive and also a clear regarding the question. And the second question goes to the three speakers, Dr. Takning, Dr. Ahsanta, and Professor Aysens. It's the question coming from Nadia. The question is about some countries has been declared to make a transition from pandemic into the endemic in response to the COVID-19. And what things should they consider carefully in the transition process pertaining of financial stability? So probably we will have Dr. Takning first to answer this question. So please, Dr. Takning.
Yes, so I think that in the meantime, in Europe's case, for example, there's another looming problem with regard to the war in Ukraine. So it's a bit difficult to readjust, for example, in the case of state guaranteed loans, for example, to tighten conditions for eligibility, etc. because of this. But it's true that it's important to address these issues, to modify, for example, eligibility criteria, so that loans, for example, are directed to firms that are really able to address or to be able to repay their loans, and to not contribute to the rise of what is called as the zombie firms. So. Yes, I think that measures have to be undertaken to further tighten probably eligibility criteria. But in the meantime, it's not necessarily the case for Europe.
Yes. Thank you. Doctor, do you have something to add on? Oh, no, thank you very much. So the second, probably Professor Aysen, do you have
thank you very much.
To add on? Yep.
First of all, I mean, the banking regulations are always difficult, I mean, especially when we are moving from one regime to another regime, in a sense, after COVID-19 period. I believe general principles like not being very quick in the judgments, having a bit some conservatism in the policy making might be helpful. Also, not to intervene in the market too much. Sometimes anyway, the market is adjusting very quickly in this sort of issues, but sometimes we assume too much roles for the regulators. The good thing is that it is for good, the transition. And even more importantly, I believe the main challenge, some of the conditions are not in our hands. For example, especially for developing countries, even we don't have the chance to completely designing our own monetary policy. We are all following Federal Reserve, ECB, and even in the regulations, it is the same again. What I would say, it is good to follow the global markets and act, but act as little as possible, or act also in a not very fast manner that will be helpful for this sort of transitions. Thank you very much.
Thank you, Professor Ihsan. And last but not least, I will invite Dr. Aksanta to address this question. Please, Dr. Aksanta.
I think I'm going to complement what Wood and Professor Ihsan already answered. So to me also, the important thing is first of all, also not being fast in the judgment whether or not the pandemic is really going to be the endemic in particular area. And as well, regarding also the digital transformation, because with the disruption of the 4.0, especially in the economy, it's kind of being accelerated by the pandemic. So we kind of moving faster and faster to digitalize everything. So let's take a look at the example. I mean, the way we deliver the lecture now, it's by Zoom, by WebEx, by everything. Everything is always based on the digital digital software. Even I mean, imagine if we do not have the pandemic in beforehand, for example, we will not be able to have the same webinar, something like this, that can connect us from many areas around the world. So I think the important part also in terms of judging about the pandemic into the endemic is also how we deal. How are we going to deal with the new normal that has been kind of established during the pandemic situation. So are we ready yet to move back to the normal life situation before the pandemic? Or we will kind of be in comfort with the new normal due to the pandemic. So I think that's all. I hope that it addressed also the question.
Thank you very much, Dr. Aksanta, and I'm afraid that will be the last question for today because due to time limit, I cannot bring up all of the question into the forum. So I do apologize to all of the to participants that already put a question into the chat box and they send another to me personally. So ladies and gentlemen, that was the end of the webinar today. Thank you for attending the international webinar on a financial institution and economic recovery with a global perspective. We already made the 5 speakers that already give us an exposure quite comprehensively where Professor Williams talked about the market structure and the banking structure, and also it's complemented by the Professor Wilson with talking about the future result in banking in the post-pandemic, and also we have an exposure how the global condition during the pandemic and also post the pandemic, and also we discuss about the digital currency with Professor Ihsan, and then Dr. would give us another perspective on how European Union and also France have the policy regarding the banking and the financial sector, and Dr. Aksanta give us an exposure with his research that are quite interesting to us also. So in this occasion, I would like to say thank you to the sponsor for today's event, Indonesian Deposit Insurance Corporation, LPS, and also all of the distinguished speakers. Thank you very much for Mr. Didik Mudiono, Board of Commission and member of LPS, and then also thank you very much Professor John Williams from Bangor University, UK, and then Professor John Wilson from University of St. Andrews, UK, and then Professor Ahmad Farouk Ihsan from Hamad bin Khalifa University, Qatar, and then Dr. Ruth Tahning from University Delimos, and last but not least Dr. Aldi Faris Aksanta from Universitas 11 Maret. And last but not least, to all of the speaker and also participants that committing to join our event until the last. So I'm Dewanti Chiningsi on behalf of the organizing committee sign out. Thank you everyone, stay safe and hope to see you in the next event.
Dengan pengumuman ini, maka pengurus bank diminta agar tidak meninggalkan Indonesia guna penyelesaian likuidasi.
Pada tahun 1998, badai krisis moneter dan perbankan menghantam Indonesia. Masyarakat berbondong-bondong antri di bank dan ATM untuk menarik dana mereka. Kekacauan terjadi di mana-mana. Situasi chaos ini disebabkan hilangnya kepercayaan dari masyarakat terhadap perbankan. 16 bank saat itu kolaps.
Wah, ini bagaimana? Uang saya hilang. Bayangkan kalau orang waktu itu uangnya ratusan juta aja udah besar sekali. Sehingga bulan Desember itu ada surat dari Mensesnek ya, kepada BI dan Menteri Keuangan untuk membantu, eksplisit disebutkan, keluarkan BLBI, bantuan likuiditas Bank Indonesia. Itu Desember itu.
Berdasarkan undang-undang ini, LPS merupakan lembaga independen yang berfungsi menjamin simpanan nasabah penyimpanan. Lembaga ini pun turut aktif dalam memelihara stabilitas sistem perbankan sesuai dengan kewenangannya. Setahun kemudian, tepatnya pada 22 September 2005, LPS resmi beroperasi.
Negara-negara lain juga masih mengalami krisis ya. Di Australia, perbankan juga, kemudian di Singapura, Malaysia, Hong Kong. Tapi terus terang waktu kita mendirikan LPS, kita banyak mengadap model dari inilah Kanada gitu ya. Karena memang itu model yang cukup bagus lah itu diambil gitu ya mengenai lembaga penjamin simpanan ini.
Major financial institutions have teetered on the edge of collapse, and some have failed.
Krisis keuangan yang berawal di Amerika Serikat pada tahun 2007, dampaknya mulai dirasakan ke seluruh dunia, termasuk negara-negara berkembang pada tahun 2008. Di Indonesia, imbas krisis keuangan tersebut mulai terasa terutama menjelang akhir 2008. Dampak krisis keuangan global yang paling terasa adalah ketatnya likuiditas di pasar uang antar bank. Penurunan harga saham yang tajam, potensi meningkatnya kredit bermasalah, serta derasnya aliran modal keluar yang menekan nilai tukar rupiah. LPS pun memasuki babak baru dalam pelaksanaan fungsinya, yaitu untuk menyehatkan kembali PT Bank Senturi Tbk. Upaya yang ditempuh nyatanya berbuah manis. Bank Senturi keluar dari status dalam pengawasan khusus oleh Bank Indonesia pada 11 Agustus 2009. Kinerja keuangan PT Bank Senturi pun terus diperbaiki hingga memenuhi ketentuan tentang kesehatan bank. Pada akhirnya, sejak 3 Oktober 2009, Bank Senturi secara resmi berganti nama menjadi PT Bank Mutiara Tbk.
Pada tahun 2014, bulan November 20, kita lakukan RUPS LB, penjualan pengalihan saham dari LPS kepada pemenang, yaitu G-Trust dari Jepang. Ya. Perusahaan yang juga bergerak di bidang keuangan, yang mempunyai aktivitas investasi keuangan di luar Jepang, yang telah juga dinyatakan oleh OJK lulus dalam fit and proper tes. Harga yang disepakati 4,4 triliun, ekuivalen dengan recovery rate 55%, ekuivalen dengan price to book ratio yang 3,2 kali. Ya, jumlah ini 3,2 kali jauh di atas rata-rata price to book value dari jual beli perbankan di Indonesia yang 2 kali.
Dalam perjalanannya, DPR dan pemerintah mengesahkan Undang-Undang Pencegahan dan Penanganan Krisis Sistem Keuangan atau PPKSK. Undang-undang ini memberikan mandat baru bagi LPS, terutama dalam penanganan krisis keuangan. Sidang Paripurna Dewan Perwakilan Rakyat pun menyetujui pengesahan Undang-Undang PPKSK secara aklamasi pada 17 Maret 2016 dan diundangkan pada 15 April 2016. Undang-Undang PPKSK juga memberikan kesempatan kepada LPS untuk masuk lebih awal ke dalam bank sistemik yang mengalami permasalahan solvabilitas. Langkah ini tentunya untuk menentukan resolusi penyihatan yang tepat.
Dengan sekarang disahkannya Undang-Undang PPKSK, peranan dan tantangan LPS menjadi semakin besar. Kalau pada saat yang lalu adalah betul-betul menjaga dan memberikan jaminan bagi simpanan masyarakat di perbankan, peranan LPS sekarang meningkat menjadi pelaksana program restrukturisasi perbankan.
LPS juga memperoleh metode baru dalam penanganan bank sistemik seperti halnya pengalihan sebagian atau seluruh aset dan kewajiban kepada bank lain atau disebut juga purchase and assumption. Kemudian, LPS dapat melakukan metode penggunaan bank perantara untuk menerima pengalihan sebagian atau seluruh aset dan kewajiban dari bank sistemik tersebut, serta penyertaan modal sementara yang telah diatur dalam Undang-Undang LPS. Undang-Undang PPKSK juga memberikan mandat kepada LPS untuk melaksanakan program restrukturisasi perbankan atau PRP dalam kondisi tertentu, seperti krisis sistem keuangan dan permasalahan sektor perbankan yang membahayakan perekonomian nasional.
Di dalam proses yang paling terakhir khususnya, itu perlu ada penguatan. Disinilah peran LPS, tugas dan wewenang LPS tidak lagi hanya sekedar menjamin simpanan masyarakat, tetapi juga memperkuat proses penanganan bank. Dan di dalam Undang-Undang PPKSK ini, tugas dan kewenangan LPS itu menjadi lebih luas. Dari sebelumnya hanya Paybox Plus menjadi juga sebagai otoritas di bidang resolusi bank.
Perkembangan sektor perbankan yang dinamis seiring dengan adanya kebutuhan internal membuat LPS melaksanakan program transformasi. Dengan latar belakang Undang-Undang PPKSK, program ini diawali dengan perubahan visi dan misi LPS. Visi LPS adalah menjadi lembaga yang terdepan, terpercaya, dan diakui di tingkat nasional dan internasional dalam menjamin simpanan nasabah dan melaksanakan resolusi bank untuk mendorong dan memelihara stabilitas sistem keuangan. Sedangkan misi LPS adalah berkomitmen untuk menyelenggarakan penjamin simpanan yang efektif dalam rangka melindungi nasabah, melaksanakan resolusi bank yang efektif dan efisien, melaksanakan penanganan krisis melalui restrukturisasi bank yang efektif dan efisien, dan berperan aktif dalam mendorong dan memelihara stabilitas sistem keuangan nasional. Berdasarkan data per Agustus 2021, jumlah rekening simpanan yang dijamin LPS telah mencapai di atas target, yaitu 99,92%, atau lebih dari 360 juta rekening. Angka ini melebihi target yang ditetapkan Undang-Undang LPS sebesar 90%. LPS bersama anggota KSSK, yakni Kementerian Keuangan, Bank Indonesia, dan OJK, melakukan koordinasi dan komunikasi secara intensif demi terciptanya sinergi kebijakan untuk menjaga stabilitas keuangan dalam rangka mendorong pemulihan ekonomi nasional.
Di usia 16 tahun ini, LPS berkomitmen untuk terus berinovasi dan memperbaiki diri, karena kami sadar amanah yang diberikan dan tantangan yang kami hadapi semakin berat. Kami berkomitmen untuk menjaga kepercayaan nasabah perbankan melalui program penjaminan simpanan dan resolusi bank. Pada kesempatan ini, izinkan saya mengucapkan terima kasih kepada seluruh masyarakat Indonesia atas dukungannya kepada LPS.